Great. So in this module, we're going to break down sort of some of the best strike prices that you can use, how to figure out where you want to enter your trades. So when you send your order to your broker, I mean, it depends on the broker, right? And that's why I created that section where I show you guys some of my top recommended brokers. But basically, you've got to show them, your strike price, pretty basic stuff, where the heck you want it to be at. And then obviously your bid slash ask for the option, right? Remember, we talked about this so much in chapter 19 of 9 to Noon, this idea of market orders versus limit orders, and options specifically are an area where you really, really do need to stick with limit orders. See, the deal is options, they're inherently a little bit less liquid than the underlying stock they represent. Specifically, if you look at a normal stock, you're going to see a lot more trading volume in the actual asset than you'll see trading volume for the options, just because there are less people trading the options. So because of that, the spreads on a stock might be a penny, might be half a penny. The spreads on an option are usually maybe like a nickel. I mean, they're pretty sizable. For like a cheaper stock, maybe a more expensive stock, might be $1. I mean, these are going to be like $1, whereas the normal spread might be like 5 cents, 10 cents. So you're looking at larger spreads with these options trades. And remember, those spreads, they directly impact the value of your option. I know a lot of positions I'm in right now, and the option premium is like 70 cents. So a difference of 5 cents is pretty freaking big in that kind of trade. And so you definitely want to try to stick, and especially with, remember, most of these trades, they're fairly, medium-term trades. They're not like you're getting in and you're getting out 5 seconds later. You can do that with some 9 to noon stocks. It's a little bit more challenging, and we'll talk about it a little bit more, but most application of options trading is going to be in swing trading. And so these positions, they're lasting maybe a couple of days, a couple of weeks, a couple of months. So you can afford to put the time in at the end and save yourself 10% on your exit or 10% on your entry at the beginning by specifying exactly where you want to get filled. And just a quick refresher for those who are newer to this stuff. Remember the market depth, obviously you have people that are trying to sell at a higher price point and people that are trying to buy at a lower price point. So for $50 stock, maybe it's $50, maybe it's $50.50. And so this 50-cent spread here is, if you do a market order, which is just a normal stock trade where you push buy, what you're really doing is you're overpaying by 50 cents because you're buying from people that are selling rather than getting in line to buy for maybe like 50 cents, $50.01. And as soon as you can get in just a little bit above this guy, you're going to have a really, really, really good chance of getting filled, but you're going to save, 49 cents. You're going to save just a little bit on that order entry and earn just a little bit more on that order exit. And it's going to help you a lot in the long term to increase those profits sustainably so that you have more profits since you get in a lower price and you get out at a higher price. And obviously the reverse is true for a short position or a put, anything where you want the price to go down, you're going to see you want to get a little bit better sales. So you sell it for a little bit more money, you buy it back for just a little bit less money. So just make sure that you are actually looking at that bid-ask option pricing. And I know a lot of brokers, some of them, they're a little bit inflexible, and you want to make sure that you look specifically. And this is why I have that whole part where I talk about, that whole webpage where I look at the best brokers currently, because it's really, really, really important that you get a solid fill. Because a difference of, 10 cents, if you have an option, maybe instead of $50, it's $5. And you're looking at a 50-cent spread on a $5 option. I mean, that's 10% right there, right? So if you can save 10% on your order entry, that's going to really, really, really help you get a lot more out of this trade. And it applies up, it applies down. It doesn't matter what your position size is. You should always be specifying your limit price when you get into these trades. And it just keeps becoming more and more important as you increase your account size, as you increase your positions. If you think about, how high your portfolio could grow with just a little bit, like a 1% better return versus, over the long run, minus that 1%, this could be a really, really, really big difference. And, this is like, if you're trading large enough, this is millions of dollars. If you're not, maybe it's hundreds of thousands of dollars, maybe it's $1,000, maybe it's $100. And I would just think, wouldn't it be cooler to make 1% more over the next 10 years? Or over the next 10 months, or over however, long your investing time frame is? I think it would be. And one of the easiest and most overlooked ways to do that is to use limit orders. So very powerful concept. Always make sure you're sticking with those limit orders and you're saving just a little bit on your entries and your exits so you can have the maximum profits once you start to submit your orders and when you get out of those orders subsequently. Very powerful concept and a very basic concept that's often overlooked, and that's why it's really, really cool that you guys are here taking advantage of this and learning about it. So strike price, this would be like the break-even price. Not the break-even price, but this is like the price of the option, right? So this is the predetermined price, and that's what we talked about later. So predetermined, if it's a call, this is what you buy at. If it's a put, this is what you sell at. And then the bid and the ask, this is the premium, right? So you want to make sure that you look at your break even. Break even, this is the most important part. How do you make money? Break even is the strike, and then plus or minus the premium. So it depends on if it's a call or a put. But I mean, you'll know this, and your broker should tell you this, what your break even price is. So if the stock's at $50, does it have to go to $55 for you to break even on a call? Or does it have to go to $45 for you to break even on a put? That would be a $5 premium. So the strike's at 50 minus the premium, that's going to be your break even price. So if you pay $5, for you to even start making money, you've got to recoup that $5. And then anything on top of that, anything that goes past this break even point is just like icing on the cake, right? That's your profit. And that's where you want to maximize your growth. You want to have the most profit possible so you can have the most growth possible, right? More growth you have, higher your break even is. If you can get more and more and more your option trades to this break even point and start to profit from more and more your trades, that's where you're going to start to see compounding growth, compounding profits, compounding portfolio, compounding bank accounts. Everything stems from your ability to make money on trades. And to make money on options trades, you need to break even. That's step one. You start negative, usually since you're paying money for the premium. So you want that to transition into positive by using strong technical setups. And then you want to increase your gain, increase your profit as much as possible so that you have really, really, really good risk-reward ratios and an awesome trading triangle, trifecta, and risk-reward ratio. And that's why it's super important that you know your strike price, know your bid ask, and know your break even. Now, here's the interesting part. If we look at typical options, there's a little bit of a spread, right? And so obviously it depends on the actual premium what your break even is going to be. So if I draw just a little bit of a sample chain, I remember this is one I'm trading right now, the OXY, okay? I'm trading OXY, and the price goes. I'm looking at them. I kind of want to see it go to like $60, and low size like $40, okay? But they have options at $50 call or $50 strike price. They have options at 45, 47.5, 52.5, 55, et cetera, right? You get the point. And with these options, obviously, the premiums are different, right? So if the stock, when I got in, it was at $49, right? So it was like right about here. When the stock's right here, the price is going to be lowest for this $50 one right here because it's closest to it, right? It has the lowest inherent value. Obviously, if you're looking at a call, you want it to go up. So these have more inherent value because they already, are worth $5, $7, $2.50. Whereas these up here, they're not worth anything. They have no inherent value. So these are going to be a lot cheaper, but this is also where you're going to get into the range of, is the stock actually going to get there? So this kind of brings into a pretty important point, especially when you're looking at entering your trade, and that's the concept of where does the stock actually break even? And not just break even, but when does it go into this term called in the money? In the money, it's just a fancy way to say break even, but it matters because when you look at your order entries, you're going to see, and you'll see this in Yahoo Finance, when you go into the options chain, you're going to have one set of options down here that's in the money, and one set of options up here that's out of the money. And obviously, this can flip if it's a put versus a call. But for this example with OXY, right, I have a call position in this, right? So if I'm looking at the ones that are in the money, these are in the money, right? This is, $50. And then these are out of the money. This is like 60 bucks. So this doesn't have any inherent value. This has no money. The only thing that gives this option value is its time value and its expected volatility. So what you're paying for when you pay for the premium is nothing except the speculative effect that this is going to go up. And that's based entirely on its expected value, whereas the expected value, whereas these options are all based on implicit value. Now, what's really interesting is these options are obviously going to be more expensive because if you have an option that lets you buy at $40 and the price is at $50, well, that's 10 bucks you got to pay right there, right? And so for the people that bought at $40 when it was at $40, they made 10 bucks. You're going to charge that 10 bucks obviously when you go out to sell it. But what's interesting is if you look at the actual break-even prices of these options, a lot of them you'll start to see you can actually get lower break-even points. So for me, it was at like 49 bucks right here, and you can see the break-even points for some of these options were a little bit higher because these are cheaper, right? So these are a lot cheaper, which means you put a lot less money into it to buy the option. So for these, the break-even point was sort of in this trading range right here is a little bit higher. But for these options that were already very, very, very expensive, for the ones that already had value and therefore they were more costly to enter the position and you would have to put more money down to control the underlying stock, those had a break-even range closer to the actual price. And some of them were just a couple of percentage points above the price of the actual spot price. Spot price, very, very, very simple. Spot price is just the current price, right? Very cool stuff. So when you look at the range of these options, you're going to see that the ones that cost more money, like the ones that have the most value, are going to have the lowest break-even point. So what I did in this trade is I actually saw this chain, and I saw that the break-even point was just a little bit, it was at like 49 bucks for the 47.5 option right here, which was super cool. And then the $50 option was at like 50 bucks break even, 52. And all these were break even at like $52. And these were break even just a little bit less than this 47.5 one. But all of those, they were like $10, $12, $15 to get in. Whereas the 47.5 option was like, I think it was like $5 a share. So I got like 200 lots, put in a position there, and I got to control a lot more shares than if I had purchased these lower value ones. But at the same time, those would have had like a lower break even, right? So these would break even just a little bit lower, and they would have a little bit more inherent value and safety if it drops, right? Because if it drops, remember, if it drops below this price right here, this is your strike price, you're left with $0. You have no money. But if it drops, all the way down here and your option's at 40 bucks, you still have a little bit of value left. So it gives you that little bit of a safety net by paying more for the option. Now, here's what I want to recommend for you guys, because I get smoked on this position as of right now. And the reason I get smoked on it is because I didn't put in the proper option trade. I got in at the wrong price. What I did was there were options right around here that were trading for like $1 a share, $2 a share. But I saw the ones that were down here, 47.5, and I said, oh, I should buy that one because it has a lower break even. It's about a 5% lower break even price. And so I did that, and those were like they were like $5 a share, right? So quintuple the price, and yet you're only going to change the actual value. You're only going to change the break even by just 1 or 2%, a very small percent right here. So you're risking a whole lot more to get a whole lot less. And so that's why a vast majority of the time, pretty much every trading situation, you really want to enter your options trades at a strike price that's very, very, very close to the spot price. What that's going to do is, and obviously you would look at it and look at the break even and make sure it makes sense, but you want to sort of minimize that upfront investment so that the upside you have is multiplied, right? So you have a higher risk-reward ratio based on a lower level of risk by putting less cash into the trade. That's a very powerful concept. You want to make sure that when you get in this position, what you're doing is you're setting yourself up for success. You're not setting yourself up for failure. And the way to do that is to trade at a level where you have a reasonable break even, not have to go up a crazy amount for you to break even. And make sure you enter a strike price that makes sense. So your break even's close, but you're not paying too much to get into the position. And a really good way to do this, right, is to use those limit orders so that when you do enter this position, you get the best deal possible by focusing on getting yourself in at the most optimal price that the market will allow you to pay. And putting it a bit just a little bit lower than the market price, so you get in at a little bit cheaper than the market price and absolutely knock it out of the water when it goes in the green, which is the goal with it, right? So a lot of really powerful concepts here. Still waiting for this trade to work out, so we'll see how it goes. I'm super excited about it. I love the setup based on technicals, and we'll break down how to really get into those technical-based trades in just a minute so that we can get your options leveraged so that not only are you actually able to scale based on stocks going up just a little and you making a lot, but you're able to multiply the rewards that you get from technical setups that are already proven to have high risk-reward ratios and have really solid success based almost entirely on the actual underlying price movement of the stock, which translates into the options premium and therefore leads to your profit. So really cool stuff, guys. Hope you got a ton of value from this and now know the exact factors that you're going to have to put into your broker, you're going to have to put into your order box, you're going to have to put in when you actually go to enter the trade. The only other thing you need to worry about is how much to buy, and that really just depends on your diversification, your position size, and your correlation. And it's obviously something we talk about 9 at noon in Chapter 35, and we'll get more into getting that optimal position size in another module. So thank you guys so much. We got a ton of value. Go out there, crush it, apply it, be amazing, and I will see you in the next module. Thank you.